Hello. Today's topic is a group of securities-based investment funds, which are bond funds. Bond funds are ranked above money market funds in terms of risk. You can access a general summary of mutual funds here. Before moving on, let's take a look at what a bond is in a nutshell. A bond is a negotiable debt security. When a business or even a government needs capital, it can turn to a bank or to investors. If it chooses investors, it issues a bond, whereby it agrees to pay the amount of the bond and the interest on it at the specified time. Since the bond is a negotiable instrument, there is nothing to prevent it from changing hands. The vast majority of the bond fund is made up of bonds. Here, the fund manager may invest not only in securities specifically called as bonds, but also in any debt security. Examples include government securities and discount treasury bills. In addition, the fund manager, of course, for its own reasons, may hold money in bank deposits with a lower risk than bonds, just like a money market fund. A bond fund can be an excellent choice for those who want to achieve their financial goals beyond 1 year but within 5 years. However, it does matter which bond fund you choose. There are different types of bond fund. They can be either actively managed bond funds or bond ETFs. Bonds are usually held either until maturity or until interest payments are made. This makes them less liquid, so it is not easy to set up a bond fund in an index tracking way. It is necessary to have a sufficiently high turnover even with lower liquidity. Not easy, but not impossible. This was already discussed in the section on ETFs, you can find that section here. Accordingly, most bond funds are actively managed. It is then up to the portfolio manager to decide which part of the assets should be made up of bonds, and specifically which bonds should make up this part. We can talk about short bond funds and long bond funds according to maturity. A short bond fund contains assets with a short maturity of 1 to 3 years. They have a lower risk level compared to a long bond fund, so they can be a good solution for people who are looking specifically for a solution for their short-term financial goals. The average maturity of bonds in long bond funds is over 3 years. As government bond yields are considered to be completely safe, this bond fund is sensitive to changes in government bond yields. Investors naturally prefer the safe yields when government bond yields are rising, so the price of the long bond fund will fall, while it will rise when government bond yields are falling. Because of this sensitivity, and because of the short-term volatility, it is advisable to choose a long bond fund for those who plan for 3 to 5 years. Now that we're on the subject of exchange rate volatility, let's look at the bond fund's yield. In terms of yields, let's look at the difference between a short bond fund and a long bond fund. As I mentioned before, the short bond fund contains assets with a maximum maturity of 3 years, its risk level is lower than the long bond fund and the level of return is accordingly adjusted. On a forint basis, their typical yield fluctuates around 1% per annum, but you can get higher yields, for example on a euro basis. The majority of them are definitely a better solution than bank deposits. This way, you don't have to take much risks as you approach your goals, but your money still works to some extent. I wouldn't recommend it for long-term capital accumulation, as the expected return doesn't exceed the average inflation rate of 3 to 4%. Long bond funds have a greater divergence, they have higher variance in their returns compared to short bond funds, but their performance is also in line with this. An average annual return of 3 to 5% compared to the previous ones may make this type of fund more attractive for those who can wait for the recommended 3 to 5 years, but do not want to think about a longer time horizon. Whether a fund invests in forint or in foreign currency also influences the trend in returns. Although you pay for the investment in forints and get forints back, your money is working in a currency such as in euro. So the strength or weakness of the forint also affects your expected return. This means that you pay either more or less for €1 when you invest, and you either get more or less when you withdraw your money from the bond fund. Returns and risk go hand in hand, so let's look at the risk of a bond fund. It is not possible to give a complete list of risks for any bond fund, so there may be risks that are specific to your personal situation and that apply only to you. This list will be much like buying a box of medicine and reading the leaflet inside the box. There you will also find a list of all the risks that might be just a little bit relevant. Even the ones that are not very likely, but are still in the deck. This time it will be no different. There will also be risks that you should know exist, but have a low probability of occurring. The first risk is the risk of changes in exchange rates, which has already been discussed. If you invest in a bond fund that is not forint-based, your money invested in forint will be converted at the prevailing daily exchange rate before being invested. This risk is not only present when buying and redeeming units. The daily exchange rate is also used to determine the net asset value of the investment fund. Although the fund manager of the bond fund makes every effort to reduce the currency risk by various means, it cannot be fully hedged. The results of the part exposed to foreign exchange risk are affected by movements in foreign exchange rates, which may affect the value of the assets, and therefore the price of the bond fund. The second risk is credit and counterparty risk. Most of the money in bond funds is held in bank deposits and debt securities. Bond funds invest money in hundreds or even thousands of directions. Before a fund manager can say yes to any direction, they must first be convinced of the prospective partner's stability. Nevertheless, even the most careful selection cannot rule out the possibility of future bankruptcy with absolute certainty. In extreme cases, the possible bankruptcy or insolvency of the financial institutions or securities issuers managing the deposit could lead to a significant reduction in the value of the assets in the bond fund, or even to their total disappearance. This could have a significant impact on the price of the units. The third risk is liquidity risk. A feature of an open-ended mutual fund is that units may be redeemed at any time. There is no time or quantity limit on redemption. This requires adequate liquidity from the fund manager. For this risk to materialize, given the huge amount of money held in bond funds, a global event similar to the 1930s crisis would be needed. It is unlikely, but it could be an extreme case where large redemptions cause investors to withdraw so much money from the bond fund that the underlying investments have to be sold out of necessity, even at below cost. Such forced sales are also detrimental to investors. The fourth in the list is the risk arising from the valuation. This mainly affects funds containing bonds traded on small exchanges. The fund manager tries to determine the price of the bond fund as accurately as possible while complying with the law. Regardless, if the lower turnover securities that make up the fund were not traded on that day, the public price will be older in the absence of turnover. While this may cause a negligible difference for a bond fund with a well-diversified portfolio, it may still temporarily under or overvalue the fund. Fifth on the list, risk due to changes in interest rates. As the bond fund's portfolios are largely made up of debt securities and bank deposits, the interest rates available to anyone will affect the fund's price. As discussed earlier, if investors can access higher interest rates through government bonds, the bond fund price will fall, and vice versa. The sixth risk you should be aware of is the risk arising from the political, economic, and regulatory environment. Political decisions can have a significant impact on the economy, and the money and capital markets are no exception. When conditions change, investment returns change, affecting the exchange rate through the net asset value calculation. Such factors include inflation, interest rate and exchange rate policies, or changes in the legal environment. Bond funds provide a good opportunity for anyone to properly align short, medium, and long-term financial goals. Although, like all investments, there are risks, these can be adequately counterbalanced by choosing the right time horizons.